I'm going to talk to you about how the FX market worked, what the fixes were and how they were set, and how traders attempted to manipulate the FX fixes. These slides need to be viewed in context. We have imposed penalties on these firms for systems and controls failures. Those failures made the misconduct by traders possible. As you can see on this slide, the FX market is absolutely massive. The daily average volume turnover of the global FX market was over $5 trillion in April 2013, according to the Bank for International Settlements 2013 survey. And to put this in perspective, you can see on the right how the size of this market compares with a few other key markets on a daily basis. The global bond market, $272 billion, the global equities market, $216 billion, and the New York Stock Exchange, $49 billion. The word fix is market speak for an FX benchmark. WMR fixes happen throughout the day, but the most widely used is the 4 p.m. fix. The 4 p.m. WMR fix is calculated by reference to trading activity during a 1-minute window or fix period, 30 seconds before and 30 seconds after 4 p.m. The 4 p.m. WMR fix rates are then published shortly thereafter. This diagram gives a hypothetical example of what the WMR fix might look like, where the purple shaded area represents the 1-minute fix period and the blue line represents the trading. Why do people want to trade at the fixed price? The Financial Stability Board's September 2014 report on FX benchmarks said that asset and other money managers want to ensure that their FX trades are executed at the same price as the fix. That eliminates any tracking error. Prior to a fix, clients often place orders with a firm to buy or sell at a specified volume of a currency pair at the fixed rate. Obviously, at that time, the future fixed rate is unknown. By agreeing to transact with clients at a fixed rate that is yet to be determined, the firm is exposed to rate movements at the fix. So as you can see here, the risk passes to the firm. A firm will typically buy or sell currency in order to manage this risk, for example by trading in the market or netting off, for example where a firm has a buying interest for the fix and trades with a market participant which has a selling interest. So in this example, the client wants to buy a currency pair and the firm is agreeing to sell that quantity of the currency pair to the client at the fixed rate. What this means in practice is that the firm with this buy order will make a profit if the average rate at which it buys the currency in the market is lower than the fixed rate at which it sells to its clients. There is nothing wrong with a firm which is legitimately managing its risk making a profit through trading at the fix. One of the issues in this case is lack of control over the chat rooms used by traders. Many firms have now imposed restrictions or outright bans on the use of chat rooms in certain circumstances. Traders use chat rooms to share information about the fix orders, to determine their trading strategies, and to attempt to manipulate the fix. This slide gives you a flavour of what these chats were like. Have a look at the blue boxes, which are some of the names the traders used to describe themselves: the players, A-team, one team, and the Three Musketeers. Then look at the yellow boxes and how the members of the chat rooms described how they operated. A three-way relationship built on immense trust. Don't want other numpties in the market to know, but not only that, is he going to protect us like we protect each other? How can I make free money with no heads up? Cheers for saying you were same way, helped me go early. I'd prefer we join forces. Perfect, let's do this, let's double team 'em. Each of the final notices has a worked trading example in it of behaviour around the fix which was able to happen because of the firm's inadequate controls over its G10 Spot FX voice trading business. We have prepared some slides which demonstrate this visually using the material from the notices, which we think helps make it clearer what was going on. An example of HSBC's involvement in this behaviour occurred on one day within the relevant period when HSBC attempted to manipulate the WMR fix in the sterling-dollar currency pair. On this day, HSBC had net client sell orders at the fix, which meant that it would benefit if it was able to move the WMR fix rate lower. Remember that the WMR fix is set based on trading during a 1-minute fix window. Let's look at what the traders were saying to each other ahead of the fix. Some of these chats are in multi-bank chat rooms and others are private one-to-one chats. Firm A has net sell orders for more than 100 million sterling at the fix. This goes up to 130 million. HSBC tells Firm A in a one-to-one chat that it has net client sell orders for 400 million sterling at the fix. Since HSBC and Firm A each needed to sell sterling at the fix, each would profit to the extent that the fix rate at which it bought sterling was lower than the average rate at which it sold sterling in the market. Firm A tells HSBC that it now has net sell orders of 150 million sterling. HSBC responds, "Let's go," and Firm A replies, "Yeah, baby." We read this as meaning that HSBC and Firm A will work together in an attempt to manipulate the fix rate downwards. Firm A hopes that other traders would also have sell orders at the fix. Hopefully a few more get same way and we can team whack it. HSBC tells Firm C in a one-to-one chat that he has a net client sell order of around 300 million sterling at the fix and asks the trader to do some digging to see if anyone else has orders in the same direction at the fix. Firm C tells HSBC that it now also has net sell orders of 83 million sterling at the fix. Firm B confirms that he also now has net sell orders for 40 million sterling at the fix. Firm A's orders have now increased to 170 million sterling. Firm D does not have any fix orders, but expects Firm A to bash the f*** out of it. In a one-to-one chat, Firm A warns HSBC that another firm, Firm E, was building in the opposite direction to them and would be buying at the fix. Firm A updates HSBC that it has netted some of its sell order off with Firm E and taken him out, so should have got rid of main buyer for you. I'm still a seller of 90. Gives us a chance. We read this as showing Firm A's belief that Firm E would no longer be transacting its orders in the opposite direction at the fix. Firm A still holds net sell orders for 90 million sterling to trade at the fix and could still participate in the attempted manipulation. This is an example of Firm A clearing the decks. What we mean by that is traders with orders in the same direction as the desired rate movement at the fix, netting off these orders with third parties outside the chat room, reducing the volume of orders held by third parties that might otherwise be transacted at the fix in the opposite direction. Remember, because HSBC is a seller, it will benefit if it can move the fix rate down. The chances of success will be improved if HSBC and other firms share information. Since HSBC and Firm A each need to sell sterling at the fix, each would profit to the extent that the fix rate at which it bought sterling was lower than the average rate at which it sold sterling in the market. This graph is a hypothetical example demonstrating this. The blue line shows where the market is trading. The green dots show HSBC's trades. The green dotted line shows HSBC's average price, and the dotted purple line is the fixed price. The gap between the fixed price and HSBC's average price represents HSBC's profit. HSBC sold approximately 70 million sterling in the half hour before the 60-second fix window around 4 p.m. During the period from 3:32 p.m. to the start of the fix window, the sterling dollar rate fell from 1.6044 to 1.6009. These early trades were designed to take advantage of the expected downwards movement in the fix rate following the discussions within the chat rooms described above. HSBC sold 311 million sterling during the fix window on Reuters and other trading platforms. The amount it sold on Reuters accounted for 51% of the volume sold in the sterling-dollar currency pair on the Reuters platform during the fix window. Cumulatively, HSBC and firms A to C accounted for 63% of selling during the fix window. Subsequently, WM Reuters published the 4 p.m. fix rate for sterling dollar at 1.6003. Let's see what they had to say after the fix. Nice work, gents. I don my hat. Bravo, couldn't have been better. Hooray, nice teamwork. Have that, my son. Be nice, mate. Don't mess with our currency. There you go. Go early, move it, hold it, push it. Love that, mate. Worked lovely. Pity we couldn't get it below the 0-0. We need a few more of those for me to get back on track this month. HSBC's trading in sterling dollar in this example generated a profit of approximately $162,000.